right? So seasonal shift at the bottom, digging up to premium rate. So we're likely to reach that buy side. And we had the previous week creating this manipulation leg right below a consolidation range. So if you go to our weekly time frame, 4-hour chart, we're looking at the fact that last week FOMC dropped down, took out the sell side, dug into a discount array here, the IRL. All right, so tags are right there. Continuing to move higher on this market maker buy model here. We now have a fib projection leg of this last manipulation leg. You can fib project it up. You put it to -2, -2.5. You could even take it from this swing high down to this swing low. That would also work. And that gives you higher targets like this, right? Because this is a retracement leg. So these should be measurements forward in price. So as we're digging up into this -2 to -2.5, and we're displacing through it, that points to this -4, which is the expected terminus now of this entire market maker buy model swing. Now, the reason that I think we're consolidating below this is a weekly array. So if we are putting now original consolidation in this case below a higher time frame PD array, we should then, at least off of this array, I'm expecting some sort of a retracement back inside the range if we form it here. If we start to just displace through here, we're going to have a complete market maker sell model back inside of the range to then take out this original consolidation right above this daily gap, or right below the daily gap. We'll drop into that range, consolidate for a while, and then move into the summer months. But that's the context of sometimes why we consolidate. Now, you could use the economic calendar as well. Tomorrow we have 8:30 news. Today we have no news. We just had 8:30 yesterday, and we just moved a great deal, okay? Price just went from expansion to then a consolidation to an expansion. What is it going to do today? Prior to a high impact news driver. That's a simple way of looking at it. It's most likely going to consolidate, and it's doing that right underneath a higher time frame PD area, which is somewhat random. So you're expecting potentially a market maker sell model coming out of this, digging back into this gap. I don't think these will be left unfilled, especially when we go back and look at the weekly chart. If this was a seasonal shift, now we have a gap here on top of, you can look at this as a breaker, right? High, low, low, high, lower, low. This would be a breaker in here. And the fact that we have a gap, now we're tagging a premium array. We either could tag this and come back into this gap and then trade off of it again, or we'll run out this high and leave this maybe as a breakaway gap, and then we're going to retrace onto this top. Using that context in mind, so we have an expansion with the 8:30 news, consolidation probably today, and then expansion tomorrow. How do we then approach that day, or how do we confirm it on a lower time frame to see, is it still telling me it's a low probability day? So this is what I'm doing on a higher time frame down to a lower time frame of, is it actually moving? So as we have a consolidation range, you're then going into the midnight opening price. At midnight open, you then should have the same exact mechanics that are forming during the session. So the fractality of the market is that each macro, each session, each daily candle, each weekly candle all follow the same process. They repeat. So when you see Asian and London doing something, you expect the same kind of precision that you'll see in the New York session. So if we're coming into midnight open here, and as soon as I'm waking up around 8:30, 9 o'clock, that's when I'm going to look at the charts on my phone and pull it up. If I see at midnight, we first run during Asian session into London, we tag out the buy side here from previous day high. Then we drop back inside the range. That's fine, right? That's normal. Into a weekly array, sweeping the buy side. Everyone likes that. Then we started to drop down. Do we displace through the swing low? Do we displace through the SysD? Do we displace through some sort of gap, right? There's no sibi in here. Instead, it comes down and takes out that swing low. That's normal, right? But we want to see a gap down to then use as a potential low risk sell in a market maker model within the New York session. But if it comes back up and tags out this buy side, we no longer can trust this as high of day. And we need to see now if the New York session now wants to roll over. If the New York session doesn't want to roll over, and then you know the session criteria to be sweep liquidity, fill a gap, ERL to IRL, IRL to ERL. If those requirements are met going into the session, if those requirements are met during the session very early, that's when you have consolidation. Or it's waiting for another move and building liquidity for the next day. So as you have the external range here, also that's the higher time frame array. Now we get into a 50-minute chart. On 15-minute chart, we'll turn on the kill zones. I'm not going to remove a lot of these weekly gaps. We'll just look at this as we normally do. Make this a little bit bigger. Minute open, takes out session high, drops down, takes out session low. Takes out session high again, dropping into a gap going into the session. What do we expect coming out of 930? Just looking at the structure, right? We just took out sell side, we just displaced up, formed a gap, we're dropping into the gap. Where do we expect 930 to go? Bullish, right? It should be continuing this move. But in line with what the higher time frame is telling us, with the lower time frame here of it being a seek and destroy kind of day, with the expectation of tomorrow is a high probability news driver, yesterday also expanded, we're not going to get a continued move, right? It's just going to stop in its tracks. So you don't expect a lot of time precision. That's going to be later on into the move. You don't expect high quality moves at all. It's going to consolidate on this kind of profile. So there's ways you can either approach it, or for me, I'm going to just watch it or just sleep in. That's really the only two things I'm going to be doing. Because to me, it's not either worth my mental capital, or I'm just going to watch it to learn it. If there's something really good, maybe during the last ditch, I'll take that, or something really early if I can scalp it. But I'm not going to spend a whole lot of mental capital on a day like today. So if something's not showing up exactly how I want it, I'm not going to be like yesterday where I'm watching from 9:30 till 11 o'clock. Like it's not going to happen. I'm going to watch it for maybe like 30 minutes and then put it to the side and go do something else. But it's not going to be a day where I'm going to be watching it from 9:30 all the way to 11 o'clock, because everything that I can learn or confirm is going to be able to be seen in hindsight for me. And I think that's the way you should approach it as well, because you're not going to burn a lot of mental capital. You'll save it for tomorrow when you need it. You're not going to get chopped up on a day like this. And then as you advance, and if you decide, okay, I think it's beneficial if you know how to trade it and how to actually approach it, because then it gives you the confidence in knowing how to skip it, if that makes sense. If you don't know what's going on in this day, you're going to fear it. And that fear alone is either going to make you approach it to say, oh, I'm better than this fear, or it's going to make you absolutely not want to understand it. And then every single time that there's a move happening during a day like this, you're going to come in and say, oh, I should maybe tweak my model to fit this day. Or, oh, maybe this is a day that I need. Or, oh, there's my model that's missed. And you want to be siphoning those kind of thoughts out. So if you know how to trade it and then know, okay, I'm going to avoid it now, it's much easier to deal with it psychologically. So as we come into the day, we're expecting seek and destroy conditions, expecting consolidation within this kind of model. We're expecting very, very early kind of market profiling. So if any of you guys have seen the advanced time guide video where I'm talking about market profiles, there's 3 that I use. This is also in the PDF. I'm talking about, you probably know the other 2, but this one's what's called a swing to Z day, where 2 to 5 will make one end of the range, 7 to 10 will make the one end of the range, and then 10 to 12 will consolidate within those 2 ranges. Unlike when London makes the low, New York open expands, London close makes the high, like we saw yesterday, very classic profile. This is going to be a more make a high, make a low, stay within the range. And it's going to be really hard to kind of get inside that move if you don't get in early or know when the move is going to happen. So I'm going to break down this entire day. So when we're expecting the move to happen early, we want to see, of course, that 930 is going to be a key volatility injection. That's going to preferably it's going to be moving, because that needs to be offering the first entry right before the first exit, and then it consolidates. So the 930 volatility injection, and then you'll have 950 macro be kind of this last ditch before the consolidation period. And then you have a new entry later on in the move during the next kind of macro window. It's typically how you approach these days. You don't want to be trading during silver bullet. You don't really even want to be trading sometimes late into the macro. Sometimes the move will happen here, it consolidates, and then there's a real, if the liquidity has been available during the silver bullet time, this will be used as this entry towards it, or it'll start a whole new move in a whole new direction. Kind of what you saw last Thursday, right? Go back and look at last Thursday when Trump was speaking. What time was that low of the session made? Go back and look at it. You'll see the same exact thing that's going on there, where it's a very low probability kind of consolidation profile up until this very last ditch. And you'll see it there too. So you have two options here. It's either trade early or trade late. Don't get in anywhere in the middle. That's it. You're not expecting a lot of precision in price, so you're not going to be shooting for really large targets. You're going to be looking to scalp moves if you go in and try and look for a trade today, which I completely think is just unavoidable. It's avoidable. Like, you don't want to be trying to trade on the day today if you can avoid it. Which, as long as you're planning on being alive tomorrow, you got a better day coming, right? So you've got the same mechanics, though, that you normally see in terms of price. Now, time is where it kind of just stays inside of that consolidation range between London and New York high. So you want to be still looking for the same exact price things of external range to internal range to external range. That's going to be true. That's a market objective, right? It's one of those market truths that's always true. So in this case, this is our time element. This is our external range. You have buy side here. It's the current daily high, right? What's wrong with that? Current daily high. And then now we've got a 15-minute gap in discount of this dealing range between this high and this low. Boom. You could use this gap or you can use this gap, right? This one was completely unfilled, so that's actually even more inefficient. It's also below the midnight opening price, right? This is more of a balanced price range. But as you then go into the lower time frames, now we look at the 1 minute. And we're keep in mind kind of how these time windows are going to be used. So right here at 9:30, it runs up, just like we were looking for at the 15-minute chart. It runs up aggressively to continue the move that happened during London, right? Let's go back to the 15. This drops down, takes out sell side, fills the gap on the hourly chart, displaces up, drops back into the inefficiency after market structure shift. What then should we do? Preferably, we go higher. That's why it drops into the gap, still moves higher. That's why you'd be bullish going into one specific time. This is why this is the bellwether chart. It's such a good chart to look at the session. We sweep the buy side going to the 1 minute, right? So you could be bullish preferably right at 9:30. Runs up there. You have a very brief sweep of sell side, as you always see, right? Brief sell side sweep. What do you expect there? What do you expect here? Go back and look at it, right? What do you expect there? What do you expect up here? If these are both major swing points for entry times, and these are smart money reversals, what should be there to confirm it? Higher time frame PD array, SMT, and what? Time. So there's windows that you look for these individual mechanics. If you see that individual mechanic during the key time, is that not a soup? You have these everywhere. You have them during 9:30, 10 o'clock, macro times, silver bullet. It's all the time. So if you know how to approach soup, it gives you a much wider range of entry models, right? Imagine if every entry model, you just have to wait it for one candle close in the direction of your draw and liquidity, and you could get it, right? So as soon as it takes out the sell side and you can enter in here, you could then put your stop at the rejection block low, target the buy side, or even target fib projections that give you where your target should be. Up there, a little random. So now your average RR would be a little bit higher. Instead of trying to get in a gap, you won't get a gap fill in here unless you go to a really low time frame like a 15-second chart, where even when we're expanding a great deal, you can find these entries. This is really the lowest time frame chart you'll ever need. You don't need the 5 second, the 1 second, none of that. Entry in here, entry in here, entry in here. What is this? What is this? Original consolidation right above higher time frame PD array. Clean market maker sell model. So this is where you could study it. Then you've got drop down. This would be the first presentation gap up here. Let's go back to the 1 minute. So 9:30, you can't count this one as the gap, right? Because that, if you go to RTH, this won't be here. So it just gaps up. Then you got boom, gap here. Use that one. Or you could use any of these ones, right? These are all inversion fair value gaps. Who cares if it's first presentation? Gap, gap, gap. Or you can mark all these out. That's the first gap, the first IFVG. Let's just mark this one out just because it's the first presentation. Now you go to 15-second chart. Do you need this? No, you don't need it. But it's going to show you the kind of accuracy that's always there on every single session you're looking at. Dropping down, displaces, kind of weakly displaces through that swing low, runs up, touches the inefficiency, drops down, displaces again. Now you have a bearish order block with a gap, entry, drops down again, displaces, bearish order block before a gap, tags up into that, boom, drops down again. Look at here. Boom, right there. Tags it, drops down again, gap with a swing low, entry off the order block, comes down and runs out now the 940 macro. 949 macro. Not 949. That's sorry, the 950 macro's over here, but we'll look at that. But it drops right before the macro time prints. Okay, that's important. That's not random, right? There's nothing in this that's random. Remind yourself of that. So we talked about getting in right at the 930 volatility injection, so you could take this long and just not that be your move and be done. Or you're looking at the 950 macro. So you could be trading, or you'd be trading this retracement back down, because now what is it doing? Sweeping external range. Now it's going to go to internal range. So you could be taking that move down based off that context. Or the 950 macro is going to be this last ditch really for this new move, where the new move is basically the New York session forming the low, and then this kind of continue move going into PM session and the lunch session, right? We kind of think of it as that. We think, okay, London did this, so New York should do that. And then lunch and PM should kind of continue or do something else relative to those two, right? Isn't that kind of what we think? So in order for this to be the last kind of retracement like higher, 950 is going to be the last ditch macro for this early move. Otherwise, you've got to wait until the entry consolidation is finished, and then it gives you another move. Drops into this. Now think about what we always see. This also is not going to leave us. 930 to 10. What's the other end of the range? Someone from chat. What's the other end? Playing time to what? Playing time? Right? So if this is also true, this element of time relative to the open, low, high, close, then we should get an entry between 9:30 to 10. What is the macro doing? What time is the high formed after? Well, we're not expecting until after 12 for it to leave that range, right? What do we talk about in terms of the swing to Z profile? It's going to be 2 to 5, 7 to 10, 10 to 12. So it has to stay within that bounds until 12 o'clock. When 12 o'clock hits, now it's going to start to spool. Now you start to see this energetic run for either the high or the low based on what the bias was. That's how time works on this kind of day. Now you approach this kind of condition. So it's either you get in long here off of the turtle soup. What do you expect down here? Between these two lows. Here's your macro time. A little bit late on it, but you should be able to see on YM. No. There you go. So this swing low created at 952 or 956. There's SMT there, right? 956 is here. So as soon as this candle sweeps the sell side, starts to print away and prints in the draw, boom, enter in there, stop at the low. What is that? Turtle soup model. And now you're targeting this buy side liquidity based on what the 15-minute narrative was telling you, right? It sweeps the buy side first because that's just in line with what price is going to do at that key time. Now it sweeps the buy side. It's got to retrace back into a discount array. That's a premium array. Buy side is a premium array. So what is it going to do? Offer discount. Also moving from external range to internal range. Then it offers this move entry based off this context using the session. Then it does what? Consolidates. Boom, 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 boom. Stays within the range, stay within the range. You get destroyed trying to trade within here. Now, if you had gotten in here, right, hypothetically, stop at the low, you wouldn't have been stopped out here unless you aggressively trimmed your stop. Like, that's why I don't understand aggressive stop trimming. If you don't see where targets are supposed to be, you're going to get stopped out without moving. You're moving it too quickly, right? Even on an intermediate term low, you're going to get stopped out here. So there's times you move it and times you don't. You have to learn where your model is allowing you to move it, sometimes when it's not, what days it's going to allow you to do that. Then you have a very, very refined rule system for, like, my whole rules for entry is maybe like 2 pages long, including all the dynamics of how I find a model. It's probably more than that. It's probably like 4 pages. It's very precise. Now, it doesn't have to be that precise in terms of an entry model, but I think in order for you to find a market opportunity, as Mark Douglas calls it, you need to have a somewhat in-depth understanding of what you're looking for. So if I know how to siphon these days out, like I mentioned, then the understanding, how I understand high probability days, it's going to be super easy. It's going to be very clean moves where it just tags it once and just flies. So you have an entry here, consolidates. Now you're looking for what? The actual last ditch macro in line with bias. What is the bias? We mentioned on 15-minute chart, it's bullish up to the buy side, potentially up to that weekly gap. Just ran into the discount IRL. Now the 1050 macro. Where's noon, first of all? This is noon. 1050 macro then offers an entry within a discount PD rate. Although it's reclaimed, we cut through candles, as ICT says. Look at the precision of where it's closing. All right, this is a bisi during the macro time. And the only discount PD rate that can be offered within the stealing range of this low to this high. Do you have look at discount? What's below that? Sell side. You sure we could sweep the sell side, or an inefficiency. But if it wants to move to liquidity, what is it going to tag? Right. So it's going to drop into the gap during the macro time. Everyone thinks, oh, surely we're bearish now, but we forgot about bias and what the overall narrative was. What time this is going to be offering in terms of the seek and destroy. Drops into the gap, fills the gap, precision there, displaces away. You could use the IFEG if you wanted to. You've got a gap in here with a bullish order block. Bam. -1 to -1.5. Surely. Another entry in there if you wanted to take that. And then, like I said before, it has to stay within the bounds between 10 to 12. Preferably what the seek and destroy or swing to Z condition is. Now it can start to move, but it also has to rely on time. So if it wants to then move here during this macro time, it can. And you can see there's a swing point there at 11:55. It kind of continues up, still kind of a tough stop sweep, like right on this swing low. Then it moves up into lunch. And then at 12:30, it starts to reverse back down. This is where it gets messy. Like at this point on, the same kind of characteristics apply, but it's just going to continue to go up and down and stay within that range. And very difficult to trade within the narrative within here. Because think about what it already did here. It already tagged the buy side. It already tagged the inefficiency. What more should it do? There's not going to be much more in terms of the session that it needs to complete. It waits till then the next session, which would be lunch. Then it completes that objective, offers a new objective criteria, and it just kind of continues that day from buy side, sell side, buy side, sell side, buy side. It's very difficult price action to look for. And in terms of trading, it's very easy for probably retail guys. You just draw 2 lines back and forth. You know, that's the perfect days that they like. But all the other days kind of don't make sense. Now for us, it's kind of flipped because this is mostly retail controlled price action, right? You think the banks are participating in this? They're not. It's mostly illiquid, bouncing back and forth. It's just retail liquidity. And it's so low that in order for it to work properly, it's just got to bang up and down. Just back to inefficiency to liquidity, back and forth, back and forth, back and forth. Now it's okay. Time to start moving. How is it random that it just offers this entry within a gap, respects the gap, and then runs up to the buy? Like, I don't understand how you can look at this and be like, oh yeah, you can go back and look at this. That's the thing. You can test any other day and the same criteria will be there. It's not like I'm making it up. The same criteria will be there. You can time the markets, right? And you look at this. You take what I'm talking about when you get to the point, right? And you understand the model, understand these days. I truly mean you can take one trade per week. One trade per week, and that'll be your entire goal, right? And it could be any day of the week because you know how to approach it. That's the power that you need. Because if you know, okay, during this time window or during this time window or during this time window, I can find my trade, even on the low probability days, it opens up like this. You have no fear of entry. You have no fear of entry because every single day it's there like a bus stop. You miss the first one, comes the next, just like ICT says, right? And if you know how to approach each time window during the week, during the day, it all actually clicks and you're like, okay, why would I take this if I'm going to lose? Especially when you understand how the setups work too, right? If you know, okay, there's going to be a turtle soup there's going to be an entry on a fair value gap, there's going to be an entry on the order block, there's going to be a run on stops probably that creates a new entry. Same market maker model you always see. Just kind of this delayed time distortion. This is kind of time distortion in here. Distorts, then new. Right, like you get in, same thing over here. First candle that prints in the direction after the SMT, go to yes. What's over here? One candle print in the direction, tags it, same candle, 956 to 1105. Same one. New candle opens, stop the low. Target the buy side, 8 to 1. Even here, 5.27 to 1. So there's these real moves that are going on even on low probability days. This one, this one, this one, this one. Probably this one too. All these major moves are going on. What do you see? What did you see yesterday though when it's even higher probability? Right at the key time, it's going to be offering that same exact entry. 9:30, right? Key time. We have 8:30 news. First window of time that's going to be an injection of volatility after that is 9:30. Market equities open. Same criteria here. Bullet, the objective is we're going higher. So what are these market functions going to be used as? Either manipulation or expansion in that direction. If 8:30 expanded, printed bullishly, what's then 9:30 going to do? It's not going to go expansion. It's going to have to, in some sense, manipulate or retrace. Now, retracing or reversing does not mean it comes down and takes the sell side all the way down here. It doesn't need to do that. This is already SMT protected. So it's just going to find lower time frame liquidity. What's the first available buy side or sell side in discount that it can run for? Boom, sell side available. Comes down, runs that out. You expect SMT to form on that kind of low. Check yes, right? We'll go over here. Check yes. Right there. 9:31. As soon as the candle prints in the direction. Limit and long. Stop at the low. 9:31 as well. You use fib projections. Even just to this range, it's a 3.75 alone. Right, then if you're using the full retracement leg, now you got it up to here. Also, you're relying on what? Time of day, 10:30. starts, which the new high should be forming, right? Between 9:30 to 10 forms the low, 10:30 to 11 it forms the high. Pops up into the -2, -2.5 post 10:30 during the macro. Is the objective complete yet? Nope. So the macro entry is going to be a retracement down, probably to take sell stops and move back higher. You look for kind of a retracement entry. Comes down, fills the gap there. Eventually continues, then noon starts. Same kind of model. All right. These same moves are always here. Low probability, high probability, doesn't matter. Every day and it doesn't stop. So when you see these and you understand them of how it relates to bias, how it relates, turtle soup is everywhere. So all you gotta do if you don't see gaps forming and you know the soup is there and you really just want to get on a retracement entry, like I only prefer retracement entries using fair value gap, then I would say maybe pick up the 15-second chart. If you really want to, can kind of constrain. That's why sometimes when you have one entry model, it's kind of difficult to get good moves, because then you're fearful because your entry model is so strict that it may only really happen one time to 2 times a month. And then it's so difficult to actually find the entry that you start freaking out and having fear. You have kind of fearful actions and you start taking more entries than you need. So even on a 15-second chart, like I said, long here, hypothetically short, demos, entries all within that range. Same thing over here is going to be turtle soup, gap. You could take that or take that, right? You may have to weather some of this. That's the problem, or you get stopped out. But if you take this, right, that's why this is outside of the time window. It's right before 10 a.m. So this entire window is going to kind of consolidate, but then entry in there, fair value gap, in there as well, So a bunch of entries. But on a 1 minute, if you kind of know, that's why I think if you understand on a 5, having a split screen like this is important, not because of the fact that, yeah, sure, you can see 2 time frames, but you actually will kind of automatically pick up how the candle on the 5-minute prints and how it looks on the 1-minute chart. So then that way, when the 1-minute candle is printing, even if you don't have the 15-second chart, you'll understand, okay, I know how this candle, like based on the way it's printing physically, you'll know what it actually looks like on a lower time frame. And then, okay, if it's actually tracing up on that 1-minute candle, even if I don't have the 15-second chart, you can get in around there and then drop it down. Advanced stuff, but that's why you could just skip it. Not, why would I burn mental capital on a day like today? It's a whole lot of work and a whole lot of very minute details that we got to remember on a day like today in order to actually successfully do it, that sometimes it's just not worth it when you probably have a better move tomorrow. 8:30, 9:30, 10 o'clock, it's all going to be there. But you have to remember, if 10 o'clock is based on a window, then what should the other ones be based on? Then the realm of entries expand a little bit more. So anyways, there's your 30-minute mark review. I don't want to go too much longer. Any questions that I missed? I don't think so. This guy. Yes, there it is. If you want to learn more, pick up the PDF, pick up the private group. I know there's a link. There's links and resources if you want to pick those up. But I didn't stream today in the morning, so this is kind of the stream instead. What can we anticipate for 8:30 news tomorrow? So we have, if you pull up Forex Factory, we've got core PPI, which according to the kind of index of news, if you will, PPI is one of those where it's not CPI, it's not NFP, but it's like right underneath. So typically there's rules that are regarding each individual news release, right? So PPI, you want to be avoiding the session prior, sometimes the sessions prior. So it's not impossible to trade, kind of even on Wednesday, right? I really have no expectations going into the news. Let the news play out. Let what London did, and then if there's a session coming into 9:30, we work it out there. What I'm expecting though, go back to the weekly gap. We're now digging into this higher time frame PD ray, the weekly gap. Put the original consolidation right on top of that, right above that inefficiency. Based on where the 4 hour is going, do we have SMT at the highs? Let's clear this out. Do we have SMT at the highs? Is it digging into a higher time frame PD ray? So we just had the weekly gap marked out, right? We check on YM. Major SMT there. ES also starting to fall off a little bit, right? ES got SMT between those sides. So now you've got SMT between ES, NASDAQ, and YM inside the higher time frame PD ray. And now if we look at the fact that on the 1 hour chart, we left the new week opening gap open. We just swept buy side, although it was external. And there's also this current weekly high over here. If people go back, this current weekly high, there's so even on higher time frames, you want to be using like weekly highs and such. So if you look at this, this is the weekly high right there. So this is a form of buy side liquidity for the 4 hour chart. It's tagging that SMT, higher time frame PD array. I would expect or hope 830 drops. We have also low resistance liquidity down here. Available liquidity pool, a large gap that's been left open, which I'm actually fine if we leave this unfilled because it's, I see this as a breakaway gap. Now, I would like if we at least took out this chunk right here, especially the chunks over here that we just left yesterday. So depending on how, that's what I'm saying, just wait to see how London and 830 prints. If London comes down, takes out this liquidity, displaces up, and then gaps up at 830, what are we expecting at 930? If it then trades into the gap further and 830 drops, that's going to be a little bit harder to see unless I see SMT between like London high or something like that. Then I can look maybe for a scalp back. But then what are we doing? We're trading back into internal range. So the move lower, at least into the gaps, towards liquidity, it's going to be easier, but towards the gaps, it's going to be difficult price action. All right. Does that make sense? I'm not saying both ways. I would favor, obviously with this continued move, I like buy side liquidity. But the fact that we left these inefficiencies on this move up, we're digging into the higher time frame PD array. We got SMT. We just left external range. I think it's likely if we at least come back into maybe this gap as a target, even during maybe 830 or London. If we fail to even fill that gap, then I'd be pretty bullish going into 930. Just take time in the morning tomorrow, right, to give yourself a good 15, 20 minutes to find your bias. Maybe overkill. You may find it in 5-10 minutes, but if you give yourself more time, it allows yourself to reason both sides, reason properly with supporting data, and actually pick one that you can resonate with. And even if it's wrong, you can flip, right? You don't marry the bias. But if you are convicted then in the trade you're taking, it's much easier to take a loss. If you're not convicted in the setup and you have doubt in your mind of whether or not it's a good setup, fear creeps in, over leveraging creeps in, over trading creeps in when you start taking losing trades, even if it's a good trade. You're not going to be convicted enough to then accept the loss. It becomes this kind of getting back game, right? We either want to feel whole again and go back to equity high, or we want to get back at the marketplace. or a combination of both. So give yourself time tomorrow to reason with a bias. Expect nothing, okay? Expect nothing. Don't expect to move higher. Don't expect to move lower. Don't expect us to move at all. Don't expect us to consolidate. You just walk into each day with zero expectation. Each individual day is its own move. It's completely new, yet it's the same. It's the snowflake analogy, right? Everything is a snowflake. Everything in this case is a market, but each day is slightly different. Some are more precise, some are less precise. So if we expect nothing, then we are able to read the data with a very clear, level-headed, non-attachment style of looking at it. And just read the data for what the data is, and then make an educated kind of guess and assumption of where the bias could be. But at the end of the day, we are trading, right? Don't overlook that. Just because we have ICT concepts that are extremely, extremely precise, like nothing you've seen before, you can still lose. We're still human. This is a machine that runs perfectly. It's always correct. You can't fight that kind of bit of understanding of the market. It's always going to be right. It's always going to do what it's going to do. You can scream at it. You can put on a 3 million lot position. It's not going to, you know what I'm saying? So if this is kind of the ultimate thing, we expect nothing. You expect nothing. You can read the data for what it is. You're no longer fearful of a trade. And you kind of forget what happened today. Forget it. You took a win, you forget about it. You took a loss, you forget about it. Enter into the day as it's a new thing, right? You don't know going to sleep if you're going to wake up tomorrow. So treat that day like it's a whole new day. And you have from midnight to make the most out of it. So you got to do the same stuff that's going to net you the reward, net you the outcome that you want. You are what you think. If you are what you think, your thoughts are then attached to your actions. Your actions are producing those thoughts, right? And that's going to dictate your reality. Perception is reality. Expect nothing. Walk into the day. You do expect 9:30 and 9:50 to be a good move. That's what you can walk into. You expect those to have specific setups, specific entries. So if you don't get it at 9:30, you're not confident about it at 9:30. Watch it through there. Expect something maybe. See, okay, if you can find an entry in there, I'm expecting it to move up to here, but I have no attachment to that. It should go up there. I obviously want to win, but if we lose, it is what it is, right? You have to approach the next one. If you're not confident about that 9:30, if you don't, that's not your model. You watch it and you use it as data going into the 9:50. Within that macro, it should do one of two things. One of two things. That's all it should do, right? Then you can find an even more confident entry in there. Take a loss on that, either move on to the next one or you close it off for the day. That'll wrap it up. Post it up probably tomorrow. Let's see how quick the Wi-Fi speed is today. I'm going to test it. I'm going to put it up. If it's like 12 minutes, I'm going to upload it. If it says 2.5 hours like last time, I'm not. So I'm going to do it tomorrow. So get some good sleep. Turn off the phones. Don't need anything. Get good sleep. Wake up tomorrow refreshed. Drink some water. Lock in. Don't expect anything. And just treat it like a new day, right? If you lost today, maybe you got destroyed today, forget about it, move in tomorrow, right? Refresh the mental capital, get a good night's sleep, refresh the mental, and we get after it tomorrow. So take care. See you in the next one. I didn't get him this time. Peace.